Well, let's turn now to Ed Yardeni for his thoughts on all of this. Ed, great to have you on the program. It's been a while since we've seen you. We want to get your views on both the economy and the markets, but let me start with the economy. You see all of the data. You see what consumers are doing with their money, all of this Fed talk. Tell us, what kind of shape is this economy in? Is it healed?
It's healing. It's growing at a subpar pace. However, by the way, if you take out government spending from real GDP, private sector economic activity has actually been growing 3% on a year-over-year basis since mid-2010. So I think a lot of what we're seeing is that the government's role in directly spending on economic goods and services has actually come down, and the private sector is not doing too badly. However, clearly the employment situation has been slow, and it's got the Fed spooked, and that's right now a major issue whether they will taper QE or not, depending on what the labor market does. All in all, the economy is growing, but it's slow.
You know, Ed, I heard you earlier today talking about something we mentioned in the introduction here. On one day, the market seems to go up because the economic data are bad. The very next day, the market seems to go up because the economic data are good. How is an investor to make sense out of that? How do you make sense out of it?
Well, you can't. I mean, you know, if it wasn't, if investing and trying to make some money here wasn't so serious, it's almost comical, really, what we've seen. Tuesday, we had really strong economic indicators. The market went up, and Wednesday, real GDP was revised down, and the market went up. I think you have to kind of tune out the noise, and we're getting a lot of noise not just from the economy, but also from the Federal Reserve. I think we do have to focus on the fundamentals that don't necessarily make those headlines. And the fact of the matter, earnings per share continue to be pretty strong. The growth rate is slowing down, but they are at a record high. And compared to the opportunities right now in the bond market, stocks still look to be a pretty decent place to invest.
Ed, you say there's noise coming from the Fed. Do you think these Fed officials are talking too much and confusing investors?
Well, if I had my druthers, we'd pass a gag order and stop them from all this chit-chat. I can't prove for sure, but I would think I was one of the early ones to call it the Federal Open Mouth Committee. They just talk too much. And, you know, the notion that talking more is going to make things clearer for us is just not working out. But it is what it is. I mean, they're going to continue to do that. And I think, look, the bottom line really message that we're getting in the past week or so is that QE will be phased out if the economy does better. If the economy doesn't do better, then QE won't be phased out. You know, think about all the troubles we had over the past 4 years. If this is our big problem, we're doing pretty well.
Enough transparency already, says Yardeni. A little more obfuscation. Isn't an environment with low inflation and moderate growth pretty good on balance for stocks?
That's a very, very good point. I've been increasingly coming to that view that, you know, usually if you have a business cycle, it tends to last about 4 or 5 years. And what happens at the tail end, you get too much inflation and the Federal Reserve has to tighten, and then you get a recession. If we continue to have low inflation and slow growth, this may last another 4 years.
All right, Ed, that's a good note to leave this on. Thank you so much. Great having you on the program. Ed Yardeni, president of Yardeni Research.